This is Gary. Gary wants to be an accountant. Gary asks, what is accounting? Well, accounting is the process of recording, summarizing, analyzing, and reporting of financial information to stakeholders for decision-making. A common question asked is bookkeeping the same as accounting? Let's look back at the definition of accounting again. Accounting is defined as a process. We can say that bookkeeping is part of the process. Bookkeeping, essentially, is just simply recording transactions without summarizing, analyzing, nor reporting. Thus, bookkeeping is not the same as accounting. Let's look at financial information in greater detail. Financial information refers to organized data about a business's economic activities, performance, and position. Financial statements are examples of financial information. These statements are the balance sheet, the income statement, and the cash flow statement. The balance sheet is a snapshot of the company's financial position. Note that the accounting equation states that all assets must equal liabilities plus equity. We will explore this in future videos. The income statement shows the performance of the business. Revenue earned is deducted from expenses incurred, therefore deriving the profit or loss for the year. The cash flow statement shows the cash inflow and outflow of the business. It shows how cash flowed from the beginning of the year to the end of the year. Let's look at stakeholders in greater detail. Stakeholders are people who have an interest in the financial information of the company. These people include the management, the employees, and the board of directors and shareholders. We can classify this group of people as internal stakeholders. Who could be the external stakeholders then? External stakeholders include investors and creditors, government and regulatory bodies, suppliers, and probably you, the customers. Let's look at decision-making in greater detail. Decision-making is largely tied to stakeholders. For internal stakeholders, the management is interested in making strategic decisions for the company. They evaluate employees and could give them bonuses for good performance. They would also want to allocate resources more efficiently in the company. The employees would be interested in whether the company is performing well enough to keep their jobs and be paid on time. The board of directors and shareholders use the financial information to assess the company's value, worth, and profitability. Shareholders might sell their shares if they feel that they are not getting value out of their investment. On the other hand, for external stakeholders, investors and creditors assess the credit risk of the company. They ask, would the company pay their debt obligations on time? Government and regulatory bodies monitor the company's finances to ensure they do not commit fraud and operate legally. Suppliers determine the creditworthiness of the company. They want to know if the business is a good friend to deal with. Customers want to be sure that the business is stable for the long term, as it might impact their interest with their goods and services. After hearing all these, Gary is now sure that he wants to be an accountant. Follow him as he takes his first few steps into the world of accounting. In the future videos, we will examine the process of accounting in greater detail by working on accounting entries and eventually prepare financial statements on your own.